Right now, hundreds of billions of dollars are pouring into U.S. tech equities. Investors are watching artificial intelligence rapidly evolve and correctly assuming it will dominate the future economy. But Jeremy Grantham is looking at the exact same data and preparing for a crash. Over his 60-year career in finance, Grantham managed up to $165 billion in assets. He built his reputation by studying the history of market euphoria. Grantham holds two thoughts in his head at the same time. First, he believes artificial intelligence ranks alongside the railroads as one of the most important ideas of the last 2 centuries. Second, he advises that if you hold a large position in U.S. technology stocks, you should sell them immediately. It sounds like a contradiction. We assume that if a technology successfully changes the world, the companies building it will make their investors rich. But history reveals a trap hidden inside that logic. A technology can successfully rewire civilization and still entirely wipe out the portfolios of the people who financed it. Surviving the AI revolution does not require a deep technical understanding of neural networks or data centers. It requires an understanding of human psychology and the highly predictable, cyclical traps we build for ourselves whenever we invent something extraordinary. The most devastating financial bubbles rarely start as scams. They build around highly visible, objectively true innovations that everyone can see will alter the economy. Take the 19th century railroad boom. The infrastructure was undeniably powerful, and the public understood it would shrink the map. Capital flooded in, and the market vastly overinvested. The technology worked, but railroad stocks collapsed anyway, taking massive amounts of public wealth down with them. A little over a century later, the exact same pattern repeated. The internet emerged as an obvious, undeniable utility. Retail and institutional money poured into desktop computing and early web companies, inflating a massive bubble of optimism. This chart shows the specific trajectory of Amazon's stock price during the tech crash of 2000. Despite being a highly functional company built on a genuinely revolutionary idea, the market correction dragged Amazon's valuation down by an astonishing 92%, wiping out the early capital of anyone who bought at the peak. The market required that violent washout phase. It burned off the excess speculative cash. Only after the wreckage settled could Amazon begin the decades-long climb to inherit the global retail world. The lesson here is brutal. Being absolutely right about the future utility of a technology offers zero protection from the valuation bubble that precedes it. The world's largest tech monopolies are currently locked in a capital expenditure war, pouring hundreds of billions of dollars into data centers and hardware as they fight for dominance in the AI space. To justify these unprecedented valuations, corporate narratives stretch further into the distant future. Companies bypass present-day reality to sell speculative stories, like asteroid mining or Mars colonization, using the sheer scale of the vision to command higher stock prices. Despite these signs of peak euphoria, institutional finance rarely issues warnings. The industry operates under a set of internal incentives that prevents them from telling clients to pull back. In a soaring bull market, advising clients to sell their tech stocks and sit on cash is seen as a professional failure. If a fund manager tells you to get out and the market keeps inflating for another 2 years, they lose their business. The manager gets fired for missing out on the profits their peers are still making. The financial industry is structurally locked into sustaining the illusion of growth until the moment it breaks. This leaves the retail investor completely on their own to interpret the warning signs of a bubble. When a super bubble gives way, wealth evaporates on a macroeconomic scale. Consumer spending contracts, corporate hiring freezes, and the economy enters a state of severe stagnation. We have a historical blueprint for what a worst-case scenario looks like. In 1989, Japan seemed to rule the world. Their technology and automotive sectors were globally dominant, and public optimism was entirely unrestrained. This chart illustrates the peak of that Japanese bubble. At the height of the frenzy, the market hit an extreme valuation of 65 times earnings. For every single dollar of actual corporate earnings, investors were happily paying $65 in market value. The 1989 crash in Japan resulted in a 35-year recovery period. It took over 3 decades for the market to simply return to its previous height, effectively trapping capital for an entire generation. Popping a bubble creates a state of capital entrapment, where net worth remains frozen while the rest of the world moves forward. It is the danger of watching your savings go nowhere for the most productive years of your life. So how do you protect yourself? Grantham's primary directive is highly controversial. He suggests looking at your portfolio and liquidating your highly priced U.S. tech equities. From there, the strategy relies on strict geographical diversification. While the U.S. market is currently priced for perfection, capital can be shifted into heavily discounted foreign equities. Grantham points specifically toward emerging markets, Japan, and parts of Europe where valuations remain grounded in reality. Next, capital should flow into what Grantham calls wholesome bonds. A bond is simply a loan you make to a government or a corporation. In exchange for your cash today, they pay you a fixed interest rate over a set period. In times of extreme equity volatility, these fixed yields provide critical capital preservation. Finally, to round out a defensive posture, a small percentage of wealth can be parked in tangible safe havens, specifically precious metals, like physical gold and silver, holding intrinsic value outside the digital financial system. Surviving the AI era requires stepping away from Wall Street's culture of infinite extrapolation. By trading euphoric tech stocks for discounted global equities, fixed bonds, and tangible assets, investors can build a historically rounded defense, protecting their wealth long before the inevitable crash arrives.